Cisco still has not surpassed its high from March of 2000. That is 23 years ago. It has not hit that high, but it is up 16% year to date. So in this video, we're going to go over a lot about Cisco. We're going to go over the financials, high-level metrics. We're going to go over analyst estimates, our 8-pillar process, and then finally, we're going to finish it with what is probably most important to you. What price should we pay for Cisco stock? I want you to focus in this video about how some of the things we talk about, including our process, can help make investing easier for you and allow you to sleep better at night, because that is our main goal here, is establishing a process that you can learn from. We're going to have things for beginners. We're going to have things for more advanced investors and everything in between. So no matter where you are in the spectrum, listen to this entire video because there'll be something in here for everyone out there. Some of it is going to be very confusing, and that's okay. It was confusing for me, and it was confusing for the other 200,000 people who've subscribed to this channel since day one. But as you know, the more you learn, the less you'll fear. The more you learn, the easier it'll become. And it doesn't happen overnight. But the good news is we're going to be around for a while. So let's get into the numbers on Cisco. So like I said, guys, look at this. Cisco was the company back in 2000. There are literally articles you can find where Cisco hit $500 billion in market cap. And they said Cisco is going to be the first $1 trillion company. That was right there. They have not surpassed this. Even in our stock, even in our software, we put the all-time high here. $82 back on March 27th of 2000. Mo, how old were you March 27th of 2000? Weren't you like 4? You were like 12.
12.
Almost 12 years old.
Yeah, not even 12.
Yeah, you were 11 years old.
23 plus years.
And guys, I'm telling you right now, if you went back here and told the average investor in Cisco that 23 years from now, the stock would have gone nowhere, they'd be like, there's no way. In fact, if I'd said
I would have loved to see a poll back then.
Oh, it'd been 0%.
Yeah.
Now, you might be thinking, well, yeah, the company sucked. Hang on a second. Let's go look at the income statement here. Last year, in the last 12 months, they've done $57 billion in revenue and generated $12.6 billion in profit. Let's see what they did back in 2000. They did $18.9 billion in revenue and $2.67 billion in profit. So their revenue is up almost 3 times, actually 3 times, and their profit is up 5 times. But why is the stock down so much? It's not like it's selling for some absurdly low PE.
Oh.
It's selling for 17 PE.
Right.
But why? When you overpay in the long run, stocks are a weighing machine. In the short run, they're a voting machine. This vote was telling us, hey, Cisco's going to be, something can stop it. The stock is going up. But in the long run, what matters are the fundamentals. That's really, really important. So guys, it's super, super important to realize that in the long run, stocks are a weighing machine. The fundamentals are what's going to drive the long-term value of the company. And if you overpay, it will eventually come back and haunt you. So some other things, what's the market cap? Like I said, 225, why are you laughing, Mo?
Because, I mean, I just can't believe that it's never gotten back to that price.
Yeah, but again,
Ever.
it's amazing to think that 23 years later, it still hasn't reached that price.
And like coming out of COVID, December of 2021, it hit a high of 64.28. That's the highest. It's not even in the realm.
Oh yeah,
it's still like
20%, 25% lower. You're right.
It's nuts.
So even if it's high post-COVID,
yeah,
it's still 25% lower than its all-time high in 2000.
Yeah.
All right, like we said before, look at this, guys. 5-year net income of 11.6 billion. Total last year's net income of 12.6. So it's not growing by a ton, but it's still growing. It's not like it's BlackBerry that's losing tons and tons of profit and revenue.
Right.
Free cash flow. Look at this. 5-year free cash flow, way higher than the 5-year net income. Last year's free cash flow, higher, way higher than last year's net income. So Cisco's actually generating more cash flow than earnings. Now you might be like, wait a second, how is that possible? Usually we see it the other way around. Well, it is possible because of accounting rules. We like to see it this way or very close to each other. The fact that we see it this way makes me feel better because all these accounting rules that go into net income are SEC, GAAP rules, all these different accounting rules. They can really manipulate your earnings. But at the end of the day, like for example, look at a company like Netflix. Mm-hmm. They have way lower free cash flow than net income. Right. And that's always been an issue for us. Mm-hmm. But in this situation, I'm good with this. Yeah. Okay, let's keep going. They pay a dividend. And here's the best part, guys. Their dividend of 2.8% cost them $6.3 billion last year. Now, if you're new to investing, you've got to remember that dividends aren't a guarantee. They're actually used a lot of times by companies to attract people to buy their stock temporarily. But what you want to compare the dividends paid to, that's why we put it on the main page of our software. We want you to compare that to the 5-year free cash flow. And here, it's only eating up 40% of their free cash flow. So they can easily afford this dividend.
Even if you go back to their worst cash flow year, which was in the last 10 years, which was 2014, it was $11 billion, still affordable.
So I'm going to go ahead and sit there and say this is probably a safe dividend.
Yep.
Wouldn't you say?
Yeah.
I think we have Cisco phones in this office building. Don't we? Don't we have Cisco phones? Is that what it is? Or am I thinking something else? No, maybe not. But they're a very popular phone for like offices and stuff like that. All right. Now, this is not to be confused with Cisco, the thong song.
Also Crisco.
Also Crisco. By the way, I remember the first time hearing, like, it was, by the way, it was 2000, 99, 2000 when the thong song came out and was super popular. And then finally realizing one day, wait a second, it's the same verse 3 times. That's all it is. There's no like...
Really?
Yeah, it's just the same verse 3 times. Yeah, great song, by the way. I remember watching Saturday Night Live, and he was playing the song, and his mic went out, and he just like literally threw it, and they threw another mic to him, and he just kept going. It was so cool. Wonder what Cisco's up to these days. We should have him appear on our channel. Okay, so let's go to the 8 pillars of Cisco. Oh my gosh.
Whoa.
Guys, remember, if you have our software, you can customize your pillars up to 12 different pillars. So that is freaking awesome. Now, guys, this is an 8-pillar company. But remember what we say. Don't just buy it because it's an 8-pillar company. I have ignored 8-pillar companies, and I have bought 8X companies. Because it all depends on what assumptions you're making about the future. But we love seeing this. Buying back shares. Buying back cheap shares. Look at this, Mo. Their net income in the last 5 years is up about $1 billion. Their cash flow in the last 5 years is up $4 billion. That's an incredible number, guys. I love that.
I like seeing that.
And like we said, we love the fact that the PE is actually higher than the price of free cash flow.
Good ROIC.
Very good ROIC. So guys, let's get into that. The ROIC is the return on invested capital. Now, this is something that I want. It's a very, very important metric that I've learned more and more about over the last 2 or 3 years. This shows us how the company reinvests its money and the return they get on that money. 17% is high. This is the market average is 9 or 10%. So when you can get above average numbers, this is what justifies paying a higher price for the company. If you look at Apple, they do 38% or so. That's a big number. That's why Warren Buffett's willing to pay such a premium for Apple. It means that if they ever find good areas to invest in, they're able to reinvest their money at very high rates of return and drive up their cash flow and profit. And that's what we want to see. Very little debt. They can pay off their debt with 1.7 years of their average free cash flow the last 5 years. Guys, this all around is great. To me, this feels a lot like a Hewlett-Packard deal, right? Except Hewlett-Packard's selling for a much lower PE and price of free cash flow, I believe.
Right.
So this is a company that, let's go look at the analyst estimates. Go ahead, Mo. You're going to say something?
Like I was just browsing here. Record revenue, record profit, record cash flow. That's the interesting thing about them.
Okay.
It's just getting better.
And look at the analyst estimates, Mo.
Very quietly, too.
It's not sexy.
No, it's not.
But it's growing.
Growth.
EPS.
Yeah.
From 388 expected this year to 484 in 2027. Not big. Mid-single digits. But guys, remember, the more boring it is, the more people ignore it, the lower the price gets, the better returns get.
You don't need sexy.
You don't need sexy. This is what I want every beginner and even advanced person. I always repeat this to myself. Sexy means popular, means overpriced. Non-sexy means unpopular, being lower priced. Which one would you rather have? Let's go to their revenue estimates. Pretty much worse than their earnings per share growth. Not growing much, guys. Not growing much. Not growing much at all. Now, this leads us, so let's do some ideas here. Let's look at some bull and bear cases on Cisco. Because guys, one of the things that Professor Oswald that we love said is a story without numbers is a fairy tale, and numbers without stories are an Excel sheet. It's about combining the two together. And that's really important for us to take the story on Cisco and see what that means about the future. Okay, so give us some bull and bear cases on Cisco.
So they're getting into the AI game, and
of course
this is it's interesting because they kind of, admittedly by the CEO, they said they missed the boat on the cloud computing area.
Oh,
so now they're kind of catching that tailwind with WebEx, trying to get into that space.
By the way, they've done WebEx very well.
Yeah, exactly. They hold 84% of computer network industry. Juniper is second with 8.47%. Yeah.
So they're 10 times higher than number 2.
Yeah, that industry
market share is 84%.
Yeah, 3.5% compounded annual growth rate through 2030. That's the expectation as an industry. Yeah, that's pretty big. Now, in communication equipment, they've lost 24% of their market share since 2012.
So that's the phone stuff I was talking about.
But again, I don't know.
Oh, what's phones? I even took, by the way, I took the phone out of my office. I don't even have it anymore because all I was getting was spam calls and people trying to sell me stuff. So I'm just like, if anybody wants me, they can call my cell phone.
Exactly. Here's a couple of stories here. This is from their investor relations. Cisco and AT&T joined forces to help business expand connectivity for a growing mobile-first workforce.
I don't even know what that means.
I don't either, but anything that touches AT&T, I get worried about. That's all. That's my big thing there. And here it is. The CEO, he said they missed the market on the cloud computing boom, so they're getting into that AI space.
They missed the initial cloud computing boom.
Yeah.
Got it.
So they're trying to jump early on AI.
Now, guys, there's probably other things here. We try to do a high level. Please comment below on any other major bull and bear cases you think exist for Cisco. And for those of you who are new to our channel, what we want to do here is whatever comments below, next time we do a Cisco video, we're going to come back to this video and see what comments were most popular, and we will make a shout out to the person who has the most liked comment that we think is relevant to the video, and we'll bring it up in our next video.
And as insignificant as you may think they are, put it in there.
Yeah,
you never know.
Listen, we want to sit there, and the vast majority of the things that people bring up, we sit there and say that's a temporary issue or that's not that big of a deal. That's what makes us different as investors. We want to worry about the long-term ramifications of the news that comes out. But still, put it down below, and if people like it, comment on it, and be respectful, guys. This is not about a battle about who's right on Cisco and who's not. But that leads us to the most important question that you're probably wondering: what price should you pay for Cisco? And again, guys, before we go into this is our stock analyzer tool that's been used over 2 million times since we started. It's super important, but remember, investing is an art. Our assumptions are going to be different this time than last time and next time, and they're going to be different than yours. So before you go further, pause this video, think about what assumptions you would make on revenue growth, profit margin, free cash flow margin, and comment below, put it in there, because we want to see what people out there are looking at in Cisco, okay? In our community here, all the time, people take a screenshot of their assumptions and put it in the community, and people engage in that. So again, put it down below, comment, get engaged about it. We love that sort of stuff. So Mo, without further ado, we're going to do a 10-year analysis on Cisco. I would like you to give me, by the way, look at this. Look at this ROIC.
I know it's increasing. Well, increasing / staying stable.
That's good.
Yeah.
So what revenue growth numbers, low, middle, and high, do you want me to put for Cisco? Remember, the analyst assumptions were literally mid-single digits.
Yeah, I was going to say 1, 3, and 5. I think they can achieve 1 all day. 5 would be tough. 3 would be the sweet spot.
So if you look at analysts, analysts are saying revenue growth of, I see what you're saying. Nope, I agree with you.
Yeah. I think 5 will be tough.
I personally think 1, 3, and 5 are low just because of inflationary environment.
Yeah.
But again, let's keep it at 1, 3, and 5.
Would you change it to 2, 4, 6?
I would probably put 2.5, 4, and 5.5.
We can do that if you want.
Well, of course, we can do that if we want.
But I put in 1, 3, 5. You put in
2, 4. I'm gonna do 2.5, 4, and 5.5.
Okay.
Nope. I'm gonna do 2.5, 3.5, and 4.5.
Okay.
All right. Profit margin. Oh wow! Look at this. Their profit margin actually increased.
Yeah.
Look at that, guys.
Yep.
In the last 10 years, it did 18.9. In the last 5 years, 22.3.
What 20, 22, and 24?
20, 22, and 24. Oh my God! Look at their free cash flow margin, Mo.
It's huge. Guys,
I don't think you can ignore this company. I'm sorry. Yes, it has a slow growth, but it is generating bigger and bigger cash flow as time goes on. I don't think this company should be ignored. Go ahead, Mo.
28, 31, 34? 28 could be low, but it's higher than their 10-year. And if they consistently keep doing it, maybe 28 is too low.
Let's do 28, 30, and 32 because they don't have much traction on the 32. It's only 1 year of numbers there. Could be a fluke.
That's true.
Right? All right. Now, PE. Now, guys, this is always the hardest one for our community members. They always say, which one do I do? Here's my thesis. You start at 15. It's the long-term average of the S&P. You go up as return on invested capital, moat, and revenue growth are strong. and you go down for the opposite. In this situation, I think the moat is high, along with the return on invested capital, in the sense of the return on invested capital could show you a good moat. But it's not really a fast-growing business. This one's going to be tougher. I know my personal stance on where I want to go, and it might actually shock some people, but Mo, go ahead.
I'm going 14, 16, 18.
Yeah, I was actually going to do like 13, 15, 17.
Mm-hmm.
So let's do in the middle, 13 and a half, 15 and a half, 17 and a half. How does that sound?
Sure.
And in price to free cash flow, same thing?
I did the same thing.
Okay. Finally, guys, last line, desired annual return. This is where you put your margin of safety in. The higher your assumptions, the more return you need because they're less likely to occur. You can get 9 or 10% from investing in a long-term ETF. So you need to figure out what's the appropriate return I need to make on Cisco. Again, not a fast-growing business. You probably got to make your money through buying back shares and dividends. So here, what are you thinking, Mo?
I'm actually thinking about going 9, 11, and 13.
Wow. See, I'm actually not even going, but we did beat it up on the...
I went lower than you on revenue growth, right? Yeah.
So I actually think because of the non-sexiness of Cisco, and I actually think I'm going to go 11, 12 and a half, and 14.
Okay.
So I'm hit the analyze button. Now, guys, if you like the software, you haven't even seen all of it. This software was built to make life easier, allow you to sleep better at night about investing with all these tools, and more importantly, our community. Our community is there, thousands of people talking every day, thousands of messages. Get part of the software. It's about $1 a day. Go to everythingmoney.com. Sign up now. Are we running a special right now? We are running a 20% off special right now. So go sign up immediately at everythingmoney.com. You will not regret it for around $1 a day. So hit the analyze button. Drum roll, please. Oh, wow. Okay. So 35 to 48 on the low side, 45 to 60 on the high side, 40 to 50 in the middle. But if you paid today's price, including dividends and everything, you're going to make about an 8.8% return if the lowest assumptions occur. If the middle assumptions occur, about 12% and 15% the high assumptions. So don't let these red numbers confuse you. These are still pretty good returns. Mo, what'd you get?
Not far off. 36 to 50 on the low end.
Okay.
50 to 71 on the high end.
Okay.
42 to 60 in the middle.
Yeah. So we're about the same numbers, even though we made different assumptions. Yep. The bottom line is maybe 12% is okay for you. Guys, I don't think this company should be ignored. I haven't added to my watch list. I'm going to do it now. I'm going to add it at $50. I'm going to go $48 on my watch list. So now the software on my phone through my app will notify me on the computer and over email. Guys, go to everythingmoney.com. Sign up now. Thanks very much.